Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special conversation. Our focus will be on DCB Bank's earnings. The bank has posted a 13.7% year-on-year growth in the profitability figure in Q4. That's reached to 177 crores versus 155.7 crores in the same quarter last year. What we've also seen is that the bank's net interest income has seen a jump of nearly 10%, rising to 558 odd crore rupees. In terms of asset quality, both on the gross and the net NPA front, we have seen an improvement from the bank, so that's an added on. And what we've also seen is that the bank has recommended a dividend of 1.35 rupees per equity share as well. To detail for us the key highlights, what's gone on behind the performance in Q4 and the outlook going forward, now we have a very special guest joining in. Mr. Praveen Kutty. He's the MD and the CEO of DCB Bank and he's with us on the program now. Warm welcome to you, sir. Thank you so much for taking the time out. Congratulations on the steady set of numbers that you've again managed to post this time around. Do tell us, sir, how have you assessed the overall earnings yourself? Has it met your own expectations and how you've ended FY25 with? Has it, marked out on all the, or ticked all the boxes for you in terms of parameters?
Thank you very much for having me here. See, we are reasonably happy with the kind of progress that we've made, but it's still very much a work in progress. There is a lot of things that we have on the anvil, but what we've achieved so far in the last 1 year, if you ask me, would you take it a year back? Certainly will. The bank has grown by 22% over the last 1 year. While that's something which is reasonably good, what we take pride in is the quality of that particular growth. On the deposit side, we've seen our granularity being maintained. Our top 20 is well below 7%, coming in at 6.61%. And in a market where liquidity was a problem, ensuring that the texture of the deposit remains the way we want to is something which we are happy with. Similarly, on the loan side, 24.7% growth. And coming in with a gross NPA of less than 3%. Yeah. Directionally, we are very happy with the way that the gross NPA is moving. The slippage ratio is looking the best it has seen is much better than last year. And also, from a provision cushion perspective, we have an operating profit, which is more than 5 times the provision which we currently have. So all in all, steady, good, sets a platform for the ambition that we have to grow the bank.
Okay. So for FY26, what can you guide us on both the deposits and the advances side and the loan growth side? What can you guide us on that front?
We want to keep the momentum going. We are a small bank. We have the ability to pick and choose. And I really believe that there is a market which is profitable and sustainable, which is available with us, and you'll see similar kind of progress happening quarter on quarter. So I wouldn't be surprised if we keep repeating what we have done consistently over the next few quarters as well.
On Kasa Deposits, could you guide us? In the past, you have managed to outperform the industry. Does that continue going forward as well?
On the Kasa part, there are two parts to it. Savings account has grown by 19.3% year on year, whereas current account has dropped. We see in the future, clearly we see SA being an integral part of our Kasa strategy, less so current account. There are new innovative products that we have put into the market. We are focused on increasing the transactions of the customer base that we have. It's a bit of a look within strategy as far as savings account is concerned. It is about ensuring that the large base that we currently have, how do we get them active? How do we engage with them more? How does it lead to transactions? And as long as there is a flow happening, float will happen. That's one part of it. The second part of it is how do we leverage partnerships, mainly with fintechs, to ensure that we acquire more customers and get the savings account piece moving. So these are the two critical agenda we have on the anvil for the year ahead on improving the cost issue.
Okay. Also, could you guide us on the NIM front, sir? What are the opportunities that you are seeking as of now? How does that go forward from here? What's the band that you would look to achieve probably in FY26? And of course, with the ongoing interest rate cuts happening now, what's the expectation on NIMs?
So if you were to see the last 3 quarters NIM, we moved up from 327 to 330, coming down to 329. That has been the sequence of NIM in the last 3 quarters. So in a sense, NIM is stabilized. In the last quarter, where we had a 25 bips rate cut, part of that has been passed on to the customer, and you see more of it happening as this quarter passes through.
Okay.
So we've absorbed parts of it. What we're doing is two things. One, on the savings account, the rates have been cut. You'll see immediate impact of that happening.
Okay.
And on term deposit, you will see the rates have been cut again, but the benefit of that will come over a period of time. It'll come over the next 12 to 15 months. On the loan side, there'll be more focus on business loans and SME overdraft facilities,
Okay.
and as compared to traditionally low yield products like home loan and co-lending. So we had a pretty massive growth in co-lending last year. I don't see that happening next year. As in the current year, you will see co-lending growing at a same pace as the rest of the products. So there's a shift to organic sourcing coming through, and there is also a shift to higher yield products within this framework that we have, which basically means we will still continue to stick to small ticket, granular, secured deposit. I don't see us
Okay.
moving into unsecured loan for the benefit of reaping in higher NIM. So within the same framework, you will see this kind of a product mix change happening on the loan side.
Okay. I actually did want to ask you about your unsecured. How much of the total book is still unsecured, sir? And how do you see that panning out?
Mainly, it is a MFI loans we have, and these loans are primarily to ensure that our small farmer, marginal farmer subsection of PSL is met. So that is going through its own set of problem. We've been taking accelerated provisions on it. If you see last quarter, the incremental credit cost that we've taken includes a portion of accelerated provisioning that we've done for this particular book.
Yes.
It's less than 2%. So it really, in the overall scheme of things, it's not too much. But honestly, every basis point matters. So that's the story on the unsecured piece. Otherwise, there is hardly any unsecured that we do.
Okay. Overall, any slippages that you had that you'd like to mark out for all our viewers, and what's the current stance and what do you see going forward from here? Also on the asset quality, there is an improvement, so there's a definitely a credit there. Do you see further improvement from the levels that you are, and what is it that you would end FY26 with?
Honestly, for a good retail bank which does secure products, we should be lower than where we currently are. So we're not very happy with where we currently are, but we are very happy with the direction that we've got. So quarter on quarter, we are seeing a reduction happening.
Yeah.
We are patient. And we continue to be patient also. And we'll see a downward movement of the gross NPA happening, primarily through two things: lower slippage ratio and the new vintage loans that we've given, giving us a better benefit as they mature over a period of time. So where we are very happy with the progress that we've made, but lots more to go.
Okay. So for FY26, help us understand, sir, what are going to be the key driving factors for you? What should we really look at?
From a DuPont perspective, I would tend to think that we get into a NIM on total asset of close to 3.3. Get to a fee to average assets of about 1.1, keep cost at about 2.5, and the provision cost overall, keep it around the 0.5 mark. So some of these numbers are something which we've already achieved. For example, on fee, we are at 1.09 versus 1.1. Provision cost, we are at 0.38 as compared to the 0.5 which I talked to you about. But on NIM front, there is definitely some work to be done. And on the cost front, while we closed the quarter at 2.53% cost to average assets. Ensuring that we get to a 2.5 for the whole year, it'll take some doing. So, but we're very conscious about it. There's work happening on this front, both from a productivity increase perspective as well as from a technology leverage perspective. So we're confident of directionally moving to these these milestones. They're not destinations; these are milestones that we have. And once we get there, then we'll go to the next level of milestones that we have in our mind.
Absolutely. So you have reiterated in the past that the bank really aims to double its balance sheet over the next 3.5 years perspective. Do you still stick to that? Is there any scope of doing that earlier than thought? What are the key triggers that this doubling will depend on, sir?
So 18 to 20% CAGR would result in a doubling in about 3.5 to 4 years time.
Okay.
Last year, we had the opportunity and we have grown by 22%. This year, because of a smaller base and the ability to pick and choose a customer, I really think that a growth of 20% is very much possible. We can pick and choose our, the segment that we want, the geography that we want to be in, and the profile that we want. So that a 3.5 year doubling the balance sheet looks very much on the cards.
Okay, fair point. Well, we will thank you then, Mr. Kutty, for being with us on the show. I wish you all the very best for the upcoming quarters as well, and look forward to again chatting with you on the overall scheme of things and how things are pacing up to achieve that net goal of yours. Many thanks for being with us and all the best, sir.
Thank you, Sakshi. Thank you very much. Good to be a part of your show.
Thank you so much, sir. Appreciate your time. With that, viewers, we wrap up this very special conversation with DCB Bank. I hope this has given you enough and more clarity as to what has really gone into this quarter and what the management is hoping to achieve in the quarters and the fiscal year that we are now into as well. What are the key triggers and the driving factors that the bank will be hoping to get. So work in progress is the key takeaway at this point in time, but the net doubling of balance sheet is possible over the next 3 to 3.5 years time frame is what the bank is also expecting to achieve. Many thanks for being with us on this special edition, but do stay tuned. I'll be back for a special conversation with other top market experts in due course. Stay tuned.
थोड़ा बताइए कभी को मार दिया
India moving to turn the floor